Thanks very much, Andrew. That was great information. I'm just going to speak to you on a couple of steps and financing options that we have here available at Alterna. So our first little step-by-step is, I know that some of this has already been covered a bit, but we're just going to go over it again. You want to arrange your initial deposit for your new property. You want to make sure that you're ready to make that down payment when you're going out and looking at your properties and making your offer. So you can do this through your savings, and it can be registered savings or non-registered savings, or you can access the equity built up in your existing home through a secured line of credit or even a secured loan. You can also look at applying for an unsecured line of credit, depending on how much you need at this point. Now, if you are thinking that this is really what you want to do and you haven't made any arrangements for your saving for your down payment yet, I am a personal money coach, so at any time you'd like to give me a call, I'd be happy to work through a budget with you and come through and do a step-by-step with you on how to save for your down payment. So now that you've got your down payment and you know how much you've got to spend to put down on your home, you really have to know how much of a mortgage can you afford. You want to apply for your pre-approval mortgage for your new property. Find out how much you can borrow to finance your new purchase before making that initial deposit. You want to look at homes that you can afford. You want to make sure that they're in your price range. Now, I know that Chris talked about going out and looking at some places before you make the offer on your home. You want to check the neighborhoods, go over your needs and your wants, and make sure you find the area where you want to go out and make your offer. So now once you've made your offer, you have to finalize your mortgage. You may find that if you are a homeowner right now, you may need to take advantage of bridge financing. Bridge financing is short-term financing that is used to bridge the financial gap before securing the long-term finance or selling a property. So if your closing date of the new property is before the sale date, you may need to borrow some funds for a short period until the present house sells. But the sale agreement for the house that you're in now must already be in place. You can borrow up to a minimum of $5,000 up to a maximum of $500,000. There is a term on this of 120 days, and with that you have your rate guarantee also for the 120 days. Now, how do you pay back your bridge financing? How is it calculated? Payments are calculated by adding the principal or your borrowed amount with the calculated interest for the number of days that you actually use the money, or for your maturity date. And your maturity date, as we talked, was the 120 days, or the sale or closing date of the existing home, whichever date comes first. A couple of other mortgage options that we have is we have a 5-year fixed rate mortgage. That's exactly what that is. It's your rate, and it's fixed for the 5 years, so it's not going to change. The term is closed, and it comes with some prepayment options available. If you're wondering why choose the 5-year fixed mortgage rate, well, it's consistent monthly payments to effectively budget your financing. So you know over the next 5 years that this is what your mortgage payment is going to be monthly. It's locked in low mortgage rates if you don't intend to move again in the next 5 years, so your rate's not going to change either, as well as your payment. And again, it allows you prepayment options to pay off your debt sooner, which can translate into savings and less interest paid in the long run. The alternative to a fixed rate mortgage is our variable rate. We have closed variable rate mortgages of 3 and 5-year terms. It's a variable rate interest, which means it does go up and down. There are prepayment options also, and this can be converted at any time into a fixed rate. You just have to give us a call, whether it's an email or a phone call, and let us know, and whatever the fixed rate is at that day, you're able to get it. So again, why choose a variable rate mortgage? Well, given the high prices in GTA, the Greater Toronto Area, and NCR, National Capital Region in Toronto, a small percentage of interest rate reduction, coupled with the extended amortization, can translate in a more affordable payments. Best of both worlds. allowing you to take advantage of the low prime lending rates while also providing the protection with the convertible option rate should the prime rate go up. We hope that this presentation has given you some insight in the process of purchasing your home. And thank you for joining us today. If you have any questions, please contact education@alterna.ca.